Okay, guys. We've spent the last few episodes talking about stablecoins, which are just tokenized money. And today we're going to go a layer up and we're going to talk about the tokenization of RWAs, which basically means every other asset out there. Treasury stocks, private credit, real estate, carbon. There's a lot of hype around what should be tokenized and what can't be tokenized. So Dave, I know you believe in the benefits of tokenization. And I know you've also said that there's a lot of tokenization theater out there. So kick us off with, what is the hype around tokenization?
Yeah, that's as usual, a loaded question with a lot of scope. But okay, tokenization today is used to describe the representation of things, financial assets, intellectual property, rights, obligations, physical things, to represent those as tokens on blockchains. I was going to add public and permissionless, but actually, let's just stay there. So it's the representation of things on blockchains, which is very broad, which is why we're going to have some fun in this episode narrowing that down. The historical arc of tokenization is we, in 2009, started with this thing called Bitcoin, which was a internet money designed to allow people to pay each other over the internet without any intermediaries. And what happened is people started to realize that the technology underpinning Bitcoin, which we call blockchain today, a chain of blocks containing ledgers of transactions, could be used to move things other than currencies. And so people started to use the Bitcoin blockchain to represent things that weren't Bitcoin, which is now what we call tokenization. And so the first sort of iteration of tokenization, they called colored coins, because you were able to take little pieces of Bitcoin and color them, basically label them, and say, this little piece of Bitcoin represents $1, or this little piece of Bitcoin represents a barrel of oil, or this piece of Bitcoin represents a Pokemon card.
And that was so before my time in Bitcoin.
Yeah,
so I do not remember that.
It was an interesting time. And so, but the Bitcoin blockchain was very slow. It didn't have like a smart contracting language, so you couldn't really build any complex business logic into any of the transaction workflows involving these things. And so Ethereum launched 2015, and people started to take this tokenization thing a step further, and really it launched this ICO boom, which anyone who's been around has probably heard, an initial coin offering, where essentially protocols and companies were going public, for lack of the better word. This has all been litigated in front of the SEC already, so I'm not but basically, and there's been a lot of controversy over the way this was done. Companies started selling their tokens, and these tokens represented some future claim on the profitability of that protocol. People were buying them because they thought that they would keep going up, right? And that boomed, right? And so, like, you know, Bitcoin went from a few hundred to a few thousand. I think it hit 20,000, and like and these ICOs were going off, and everyone started paying attention. And
this is around 2017.
Yeah, I'd say like 2016, 2017, and then a bunch of like large financial institutions, players in the traditional financial markets, started to look at this and say, "What the hell's going on over there?" A lot of people are getting really rich. A lot of people are getting really poor because these things are going up and crashing. And you know, I was a part of this cohort where we started to look at the blockchain and say, how do we take this concept of tokenization, which these tokens are really interesting because they can move around the internet peer-to-peer, real-time, 24/7 by 365. Like, these capabilities could be really used to make the existing financial system a lot more efficient. But we don't trust these public permissionless blockchains because who controls them? Isn't there a lot of money laundering going on? Isn't Bitcoin used to buy drugs, et cetera, et cetera? It's an oversimplification. So a lot of these financial institutions started to build basically consortiums, private consortiums, groups of banks and industry participants, and started to tokenize things. Invoices, dollars, stocks, bonds, I mean, pretty much everything, but doing it in a very private and controlled manner. And those really didn't go anywhere. They didn't have any of the network effects that we see today. And I think the industry just generally wasn't ready. The first real killer application of tokenization was actually the dollar. And so in 2019, 2020, you start to see tokenized dollars, stable coins, start to take off and really do that in the context of crypto trading. At the same time, the crypto prices, basically market capitalization, exploded from, below $1 trillion to, ballooned up to $3 trillion. And there was a reignition of institutional interest in tokenization. And so that kind of brings us to where we are today, which is over the last, let's call it 2 to 3 years, you've seen stable coins become the killer application of tokenization, cross over $300 billion in market capitalization. NASDAQ, New York Stock Exchange, major markets want to clear equities and bonds and derivatives and stable coins. You've seen some of the largest fund managers in the world, Franklin Templeton, Wisdom Tree, BlackRock, Apollo, KKR, tokenize their existing funds, right? And you've seen figureheads like Vlad from Robinhood, Larry Fink from BlackRock basically come out and say, in the future, all things, in their case, primarily financial assets, stocks, bonds, private credit, loans, will be in tokenized form because for reasons we're going to discuss on the show. And that's kind of the historical arc. And that's why it's a big deal.
Yeah. Just for reference. So stablecoins projection is that we're going to be at 3 trillion by 2030.
Right.
BCG thinks tokenized assets are going to be at 19 trillion by like 2030, 2033-ish. Right. So this dwarfs even what the tokenized dollar could do. And so that's why I think it's important that we spend this whole episode on it. Yeah. So when we think about, actually, before we go there, Ian, why does it matter though? Like, why is Larry Fink saying we should tokenize everything that we do?
Well, first off, good to see you guys in person.
Yeah.
It's so live fun. and not on Memorex. Boomer reference.
I don't know what that is.
You don't know what Memorex is?
No.
Oh man, Memorex were these blank cassette tapes
that
you could record voices on your cassette player, and they'd sell the Memorex tapes.
Did you used to do that?
I mean, yes. I am of the tape generation. Old enough.
Okay. Anyways.
And shout out El Tiempo for the best Tex-Mex I've ever had last night.
Yeah, we're calling in live from Houston, Texas.
So good. Okay.
Tex-Mex capital.
So good. Okay. So why does tokenization matter? Well, for financial institutions, the digitization and tokenization of financial instruments leads to efficiency gains that increase their profitability and their margins. So there are a number of financial institutions which are using, let's take stablecoins as tokenized dollars, in their business to increase efficiency, capital efficiency, and technology efficiency. I think in a prior episode, we talked about how Western Union was making use of stablecoins, so they had less of their own balance sheet tied up in the float of money center banks. And so that's really just a accretion to their bottom line. I think broadly, tokenization gives access to more people around the world, to more people to invest in more things. We see almost an insatiable appetite globally for U.S. dollar-denominated financial instruments.
So pause there, though. So, I think that's incredibly powerful. When we think about, we've said this on multiple episodes, and we say this all the time when we're in person together, but anyone, anywhere can soon buy U.S. equities.
Yes.
And but how and kind of why?
Well, a few things. When things are on a blockchain, the market never closes. So there's the basic issue of it's midnight when the stock market in the U.S. is open. That's kind of inconvenient. So we're going to go, New York Stock Exchange is at the forefront of this with others. We're going to go to 24/7, 365 stock trading. And to make that as efficient as possible and as global as possible, doing that on a blockchain in a tokenized way is superior to the current model that has T+2, for instance, settlement in common stock. Pulling the lens back. So why is tokenization important? It's important for companies as they think about optimizing their own balance sheet and their own tech stack. It's important for global investors because it gives more of them access to more items that they might want to invest in with their savings. It's important to when we talk about stablecoins, it's important for retailers and for commerce of a traditional kind that's maybe internet based to be able to process transactions more quickly. It's important in an agentic universe where machines will be transacting with other machines in marketplaces, and you can't do that without instantaneous settlement. You can't do instantaneous settlement on the one hand without stablecoins, but on the other hand without the assets that are being purchased being tokenized themselves. So in a world where companies want to optimize themselves, markets want to grow and be more optimized, commercial enterprise of a traditional nature wants to move at the speed of light, and in preparation for an agentic world where our bots will be doing a lot of things for us, tokenizing assets, tokenizing the financial payment rails becomes not just a nice to have, but the necessary next step for financial infrastructure.
Is it too simplified to say this is just digitizing everything?
I think it is. Look, we digitize things when we got computer screens, right? We digitized things in the way we represented things. I think what separates this, and I call it digital finance because I think the cryptography aspect is we can take for granted. Like computers used to be people and then they were machines, but we don't call them electric computers and human computers. We just call them computers. So I think crypto is a little outdated, and I'd like to think of it as digital finance or blockchain. But it is the next iteration of digital finance. And how is it different? It's different because these instruments can be represented in a way where they can be transacted instantaneously via atomic swaps with stablecoins or with other tokenized instruments.
Okay, explain atomic swaps for our listeners.
It's basically the smart contract settlement where you can take a stablecoin or any tokenized asset, be it dollar or otherwise, and another tokenized asset, and instantaneously trade them, take them from one wallet and put them into another in a completely safe and trustless manner.
And I think, so for anyone that's not familiar with how settlement works today, that what you just described might not seem like such a big change. Like if you're just like a normal retail investor, like, wait a second, I can buy, the stock looks like when I buy it on Robinhood, it seemed pretty instant. But in the existing capital markets and debt markets and payment systems, there's a lag between the message where you've basically signaled some intent, like I want to buy this thing or I want to send this money, and where all of the different ledgers involved and all the different institutions involved in executing that have been updated. So in this is vast oversimplification, but the bull case for tokenization is basically in financial markets today, we have tens of thousands of different participants. They all maintain their own siloed ledger of who has what, who's owed what. And the financial systems are just basically these institutions trading messages back and forth that say, please reflect this change to your ledger and I'll do the same on my end. And then at some point in the future, we'll have to reconcile those to make sure that, you know, all of this actually netted out and that all these transactions were reflected properly. And so what that's manifested itself more concretely is clearinghouses like ACH, like the DTCC. Basically all over the world, you have these market coordinators who make sure that all of these different ledger updates across all of these very old systems are happening in a coherent way and that they actually reflect the intent and state that the participants intended them to. This is a very inefficient process today, right? It only works in batches primarily. It only works during business hours. It only works during weekdays, right? And then there's armies of people that basically run these back offices to make sure all of this reconciliation and the settlement is done. People that are proponents of tokenization say, and all blockchain is really doing is bringing all of this into one distributed ledger. So everyone has the same view of the world and they can say, I know what I see is what you see. And that we all work off one single global distributed ledger. And so we don't have all these different disparate systems. We don't have all these really expensive reconciliation processes. We don't have all these sort of digital islands where we have, armies of people or middleware to sort of handle the translation between how all of these things coordinate. And if we can just do this all in one big ledger, everything will be much more efficient, much faster, much cheaper, much more accurate. And that will be basically nirvana. It's a lot more complicated than that, as we found out. Like that's like a vast oversimplification.
I think that's right. But one of the things that is a vast oversimplification, and I think and tokenization may not be meant for all use cases in all ways. But one thing that what you said highlights and should highlight to everybody is if I was going to create a financial infrastructure from whole cloth for something new today, I wouldn't want to do it the way that we created financial infrastructure in a pre-blockchain world. All of those back offices, all of those settlement delays, all those ledgers that need to be reconciled, all that bifurcation and fragmentation of liquidity based on jurisdictions. If I was going to create a new marketplace today for financial instruments, I would not use the pre-blockchain tech stack. I would use the blockchain tech stack. And this is relevant as the world becomes more globalized, as some asset classes like private credit were 500 billion a decade ago on their way to 5 trillion. You're seeing log scale growth of private markets, and those private markets give an enhanced risk return profile to domestic and international investors, but really do not have an infrastructure to support them. And so the question is, if we're going to create a market infrastructure to increase the liquidity and the capital efficiency of those markets, what does that infrastructure look like? And just as we see this rise in private markets and this challenge that presents itself, we find the solution in blockchain, in instantaneous settlement, in the tokenization of these instruments.
Okay, so if we're summarizing, tokenization is an important concept because optimization, right? Efficiency, trustlessness, distribution, and what else?
I think there's a composability aspect. You can customize what the cash flows are going to be, and I think we're just at the tip of the iceberg for what that's going to look like. Yeah. We've got, to some extent, the financial engineering that we have has been limited by the operational capacity of the financial markets. For instance, if I buy a bond or a loan at 10 a.m. or if I buy one at 2 p.m. in the current system, so Dave buys a bond at 10 a.m., I buy it at 2 p.m. We both are the same trade date. We both settle T plus whatever. We both accrue the same amount of interest. But that doesn't make any sense. He's committed his capital at a different time than I have. And so we should have a differentiated accrual of interest. With blockchain and instantaneous settlement, you get that. That is an important customization at sort of a Delta 1 level, but you can build that up when you think about securitizations, when you think about variable cash flows, when you think about variable performance frameworks. I think all of that sort of new chapter in finance will be born out of the increased capacity for this blockchain-based infrastructure to support composable cash flows and customized cash flows.
Yeah, that's actually really interesting.
I think what you said in terms of what the benefits are is generally true in like a normative, like ideal state of the world. But what we've seen with all these tokenization efforts is like, that's not actually where you start. Let me explain what I mean by that. Is ultimately what the tokenization thesis depends on is network effects. So for this global public ledger to add value, everyone has to adopt that global public ledger. Otherwise, if you just have a bunch of people, a bunch of institutions running their own blockchain, you just have recreated the exact problem that you set out to solve. You just have all these different blockchain networks. None of them coordinate with one another. Tokenization is basically like a technological reframing of like what is really just like a massive coordination problem, which is how do we get all of these different parties to use the same infrastructure for recording who has what and managing settlement of assets over that ledger. And so like the question that I always ask myself when I see any sort of tokenization use case is like, what are they really trying to like solve there? Like, what is because you could really make an argument that like a lot of people would, that like a lot of these use cases like don't need a blockchain, where it's like, why are we doing that on a blockchain? Really all the blockchain is doing is like solving this coordination problem. It's getting everyone to agree that we're going to use the same ledger, but like, why does that ledger need to be like a blockchain? Why can't it just be a database?
This is a great point, actually. I want us to get into this tension.
Yeah,
I think
which
is like what to tokenize, what not to tokenize.
I think if you were to create a market from scratch with a market infrastructure from scratch on a centralized database where there was no trust in that central authority and no uniformity associated there, you would have a network effect problem. I think there's an aspect to a public blockchain where everybody can see what time each transaction takes place, and it's totally trustless based on systemic swap idea. I think that's an easier way actually to jumpstart new market infrastructures for new asset classes. I think the best argument for not tokenizing is where you already have spent generations building up a working, orderly infrastructure.
But isn't that like, like the New York Stock Exchange? Like, right. It's the same like 50 or 100 like large institutions that are doing the brokerage, the custody, the settlement. Like, you don't think BNY Mellon doesn't trust JP Morgan? Of course they do. They have a central. Sure. They have a.
So I think where you have a pre-existing. If I was going to start a new market from scratch. And by the way, there are big markets that exist that don't have marketplaces.
Yeah.
Private credit, early stage venture, many private companies.
Prediction markets.
Prediction. I mean, you see this. You see markets without marketplaces in a lot of circumstances, and just the cost, just the technology stack cost of, I could either recreate the existing market infrastructure or I could have a new market infrastructure based on blockchain. It's clearly more efficient to do with a blockchain infrastructure. And I do think where you have legacy systems. So I would say a few things. Tokenization is best when you're creating a new market infrastructure that hasn't existed before, because this infrastructure is cheaper, faster, safer, more transparent, more trustable. So I would make that point. The second is tokenization is valuable when you're looking for global distribution. Many of the traditional infrastructure frameworks are quite jurisdictional centric. And so you operate in the US by US people doing US things off of US bank rails in the US way. If you want to have global distribution, you need to kind of break free of that idea. Tokenization is a way to do it because you can get those assets out into the world and be outside of the traditional banking system, outside of the traditional trust and custody frameworks. So if I'm not going to export the US infrastructure globally, which even if the US players and the US government wanted to do that, the domestic governments and institutions around the world may not be so inviting of it. This sits as a parallel universe, as a parallel ecosystem to the pre-existing one. And so once again, if you were going to start a market infrastructure from scratch, blockchain's a cheaper ledger framework, just from a build perspective. If you were going to take assets and try to make them more global and to get away from the institutions that make things jurisdictionally centric, then blockchain once again sits outside of these traditional rails of these traditional oligopolies and gives people an opportunity to participate in these markets at a global scale. I think those are your two best use cases. The third best use case that I might add to that, and obviously we're working hard on at Profiter, is where you have markets that are insecure when it comes to execution. What do I mean by that? There are so many markets out there where people spend a lot of time with a screen and two phones. Hey, will you buy this? Will you sell this? Okay, great. We agree on price. We agree on everything, but maybe we don't agree on the docs, or maybe the money doesn't come through, or maybe the proof of the asset isn't there. If you use instantaneous settlement, which can only be done with stablecoins and tokenization, then you have surety of execution. And with surety of execution, you materially reduce the operating costs of people that are trying to transact, and that reduced operating costs increases capital efficiency, and increased capital efficiency is a benefit that's shared by everybody.
There's something that we haven't hit on though that gets a lot of hype, and so let's unpack it a little bit. A lot of people are like, once something's tokenized, then they're liquid markets.
That's definitely not true.
Right. So unpack that though a little bit, because that is a narrative. That is a narrative. And a lot of people who are actually building in the space or who understand finance are saying that's not the way this works. But why does that narrative exist? And how do you actually get there to create liquidity?
There are many
in
things
illiquid markets
that you can trade that don't trade. The best determinant of, if I had to pick one variable, of how much something will trade is the size of the market in it. We have perfectly functioning stock markets, but if I've got a $50 million market cap equity, I'm not going to see this robust trading or market making or any of this liquidity provisioning that takes place. On the other hand, I could take a really massive market that's inefficiently transacted, take physical crude, huge market, rather inefficient, but it trades.
I love the shout out. Are you saying it because we're in Houston?
Shout out Houston.
Good job.
But that's a inefficient market with not a lot of infrastructure. Certainly doesn't operate at the speed of the internet, but it trades every day in size because it's just so big. If you want to see, if what your goal is to see a lot of trading in tokenized assets, get asset pools that are big. Asset pools that are big will drive the most trading volume. It sounds like stupid and obvious, but if I tokenize your baseball card collection, we're not going to see Jump and Jane Street and Susquehanna and everybody making markets on it and creating this super liquid tight bid offer spread just because we tokenize your baseball card collection. It's too small.
Which is why
it's capital inefficient for people to make tight markets in it because they can't put money to work in this small cap instrument.
Which is why all the most successful liquid tokenization projects today focus on things that are already large and liquid markets.
Yep.
Dollars, U.S. treasuries, money market funds. The narrative I think that you're hitting on, Sam, is that one of the big narratives is that we're going to tokenize private credit, which has traditionally been, as we've seen recently, is an illiquid asset class, right? Private credit is
illiquid, inefficient.
But it's illiquid because it involves loans to private companies with pretty long tenors, right?
Well, even short-dated private credit.
Yeah.
I mean, to jump in a little bit, I think one of the things, once again, we on this podcast, we try not to talk about our own companies, but this is sort of right down the fairway for profiters. So we've seen let me come back to this in a minute. I just want to finish the thought. What I was saying was, if you're trying to optimize for market trading, have big pools of asset. But there are other things to optimize for. I just want to make the point, some assets are really difficult to transfer. So if you want to increase the transferability of an asset, and this comes to private credit, then tokenizing it makes it easier. Okay, so you could see relatively small loans in the private credit space, but you can see them transact if you have certainty of execution.
Yeah.
Once again, I may have a $50 million loan, a $100 million loan. That doesn't mean we're going to see active market making in it. But what it does mean is that we can move away from the heterogeneity that exists in the private credit market and move to a more homogeneous framework. Importantly, a homogeneous framework where you have surety of settlement. So after you spend all the time going through the legal docs and you spend all the time figuring out if you want to buy this instrument, and if you figure out that the other side's got the money, and all of these things put together, at least with blockchain and with instantaneous settlement, there's zero execution risk. So you know that all of that work will result in a transaction because the token is there, the stable coins are there, they instantaneously settle. I think that that's a pretty big innovation. So whilst if you want the liquidity and just because you tokenize things doesn't mean you get deep secondary market liquidity. It certainly, that's, as I said, driven by market. But what you can see is a transferability where that was before very difficult. And that's an efficiency gain that should move away from the heterogeneity. And
is that a big enough pain point for mass adoption of everything private credit being tokenized?
Private equity. I mean, look, I can tell you there is just an unspeakable amount of time that is spent in the private equity space where people are trying to buy, where people are trying to buy pieces of ByteDance. If I had a nickel for everybody who said they've got 100 million of ByteDance to buy and here's their money, and I've got 100 million of ByteDance to sell and here's my proof of shares at the same price where that transaction did not go through, I mean, it might be a lot richer. Like the reality is that everybody can say whatever they want to do. And in the way that we're transacting now, where proof of shares is complicated and settlements uncertain, the rest of it, very little gets done. So there's a lot of wasted human capital, really inefficient markets, really wide bid offer spreads. Ultimately, it's bad for everybody. And if you create that efficiency through instantaneous settlement, I do think people that will do away with a pain point. And I do think that if you can move, so that's an example in private equity, in private credit, I think if you can move to a place where you have where subparticipations in loans are more easily transferable, you will see a more robust market, secondary market, and with that you'll see more capital efficiency. You'll see a leveraged loan market that's easier to manage, and you will allow more access to more people into this asset class, which is ultimately benefits borrowers and savers.
Well, and it does bring some liquidity.
Yeah, I mean,
but there's a lot of wood to chop before you get to the liquidity.
The amount of liquidity that you see is going to be a function of how deep each of those assets is, but transferability is also valuable. So in the land of the blind, the one-eyed man is king. Like where it's very difficult to transfer these sub-participation agreements right now, and it's thorny and complicated, and everybody's got different docs and settlement times are long. Knowing that happens instantaneously in a uniform way is a big value add.
So there's like a technological component, yes. The devil's advocate would say, so we have this big private credit market. These assets exist as 300-page PDFs. It's really hard to move them around. They're not fungible, right? So you can't trade them like you can stocks. Like they exist in a PDF file on someone's computer. And if you want to transfer it, you need lawyers and weeks to do that.
Mostly that's a function of heterogeneity in the market.
Yes.
So
how does but where I'm going is that, like, I think a lot of the problems that tokenization purports to solve today is as much legal technology as it is technology.
Okay, so let's take this in the inverse. Let's say I made everybody in the private credit market use the same set of docs. Let's assume blockchain doesn't exist as this thing.
Yeah.
And let's assume that we're trying to achieve this goal of creating capital efficiency in the private credit market through transferability and homogeneity of execution, and we do that through legal documentation. Okay.
And a centralized database, though.
Come to that in a minute. So if I just had the legal framework as it is, that would still leave me with not knowing whether or not people are going to really trade after spending a lot of time negotiating it. Now, so that's good to have, but it doesn't get you there. You need a way where with that, it's everybody's got that uniformity and they have a 100% certainty of execution. Now, how do you get that? Now, we could have a decentralized database. We can have a centralized database. If I start that business today, and I say to ABC originator, hey, that loan just came off your books and went to that buyer's books at 11 a.m. So you owe them interest from 11 a.m. So, well, how do I know it wasn't at 4 p.m.? Why do I owe them an extra 5 hours of interest? Because my internal database said so. That's not going to fly. If instead I have a public blockchain where everybody can easily see what was transacted, when, and how, at least I have one less issue to overcome now, which is the need for trust on what the ledger says. That said, if I was some amazingly trusted institution, of which there are fewer and fewer in society, but let's say that there was perfect trust, maybe that would work. Would still make it difficult for me to have composability of interest and a few other things, but maybe that would work. What we're really saying is where market infrastructure doesn't exist, as it doesn't now in private credit, it doesn't now in private equity, it doesn't in a number of things. How do we go about making a marketplace in these markets? First thing we need to do is we need to create some uniformity across legal documentation. Second thing we need to do is we need to make sure that we've got 100% execution certainty. Third thing we need to do is we need to record these transactions in a way that is the lowest cost to the highest trust possible, because trust is a very expensive thing to build. And I basically get the trust, almost 100% trust in transaction time and volume by using a public blockchain at zero cost. Whereas if I were to build that internal database, holding aside whether I can build it internally, which of course I can, the cost to get everybody to trust that in a multi-trillion-dollar market is yet another massive cost. So I've got the cost of creating homogeneous documentation, the cost of instantaneous settlement, which is tokenization, and the cost of trust. The third piece that you're speaking about, the cost of trust, is materially reduced by using a public blockchain.
I think that's so first of all, the point I wanted to make was tokenization is as much a rewiring of the legal frameworks that underpin this activity as it is the technical piece. Like there is no world. It all goes together. There's no world where you just throw things on the blockchain. Totally. Like that makes everything better. Totally. It's like, oh, we're using this database. Oh, that's great. Like in some use cases, it's like 90% legal rewiring and 10% technology rewiring. I'm not saying that's all use cases, but
you've got to get 100% of the way there.
Yeah.
So holding aside,
yeah.
Let's not miss the forest from the trees. At the end of the day, what we're trying to do is create new market infrastructures where ones don't exist, so we can create marketplaces in multi-trillion-dollar markets, and those marketplaces be globally available. Right? That's the meta. That meta requires a lot of things. It requires the legal piece, the legal engineering. It requires the tokenization. It also requires marketing. It also requires operations. It requires
people wanting to buy.
It requires venture capitalists funding these platforms. There's a whole host of things to get to that end state. But the question that we in the financial services industry is facing, what is the cheapest, fastest, most efficient way to get there? And a public blockchain is in many ways a better arrow in the quiver than a private blockchain, or aka internal.
But for reasons ledger that I don't think are like necessarily apparent to the people that are even talking about doing this. Like I don't think Larry Fink actually realizes like the reason, because blockchains are slower, more expensive databases, right? Like they have like just using like DynamoDB, like it's way faster and more efficient to use like a centralized database than Ethereum.
Yeah,
right?
well, if you look at the core banking systems that exist, they're super efficient. The issue is the one that I described, which is how do you open up that database for everybody to benefit from the composability and the network effects and the engagement? And if you can't do that, then you're a relatively siloed piece that doesn't get to where we're trying to go.
And that's the core point that I'm driving at. It's like if you look at basically 3 states of the world, you say we have all these disparate ledgers, and or we don't have a ledger at all, which is what you're talking about. Like we don't have any infrastructure for this market. Like it exists entirely on paper, like trade finance or private credit. Or we have a digital industry, but very disconnected, like equities, right? Where we have all these different institutions and they're really struggling to get all these different systems to communicate with one another and blah, blah, blah. You could basically solve that problem 2 ways. You could say all the world needs to put all of the data and all of the transactions into this one single global centralized database. You could do that. That would actually solve the problem, technically speaking. But the issue with that approach is you will never get the entire world to agree on who owns that database, who's responsible for maintaining it, what the rules are around making changes to it, where the data center sits for,
and its evolution,
where that data, exactly. What's the governance around that? So you basically have this coordination problem where like you theoretically could have all of the world put all of the world's like financial data in a single database and it'd be like super efficient and like there'd be no reconciliation. Everything would settle instantly, atomically. All the things that you're talking about could exist in this world, but we just won't have the ability for all of these participants to agree to trust the governance. And that is the core. That's actually like the core unlock of blockchains. That's why I'm driving at this.
And I would add one thing to that. So I agree. So it's the cheapest way to get to trust, and trust is necessary to get to scale.
And because of the way they work, they are credibly neutral in that no one owns them. So like they are decentralized, and like that goes to the heart of like proof of stake and mining and how all these things actually secure themselves, and the economics behind that means that we have this infrastructure that can serve as this global database where we don't need to appoint one single sort of coordinating party to run that database and put trust in that coordinating party, especially when you look at like an increasingly polar world where, is like, if we settle all of the world's dollars like in a single global database as opposed to on a decentralized blockchain, like what happens when there's a trade war? Well, yeah. Like, do we like what,
Well, this concept is even more acute around the world where you see countries that have closed capital accounts.
Yeah.
Look, we have a world in which most people can't buy most of the things they want most of the time. Okay. America's uniquely deep in liquid markets and freedoms sometimes make it hard for us to appreciate the paucity of investment opportunities that people can commit their savings to around the world. The most obvious example of that are capital accounts, where you simply can't buy global assets because you can't exchange the local currency for the dollars or the other currencies required to go buy Apple stock, right? So how do I get somebody in Argentina to be able to buy Apple stock when they want, how they want, without creating a tokenized framework that can sit outside of that banking infrastructure, that outside of that government infrastructure? So, once again, it comes down to if you're trying to make a market infrastructure where one does not exist for the reasons we described, not the least of which is the very cheap cost of getting trust. There you go. Where you want transferability in assets where transferability is difficult because there's no uniformity and you want 100% certainty of execution, blockchain's the way to go. And then when you want to make this as globally available to people as possible, where their options are limited by the institutions that exist, tokenization is the way to go.
I agree. The reason I'm driving at this point, though, around why a blockchain excels in certain use cases over a centralized database, and it really does come down to like a non-technological problem. Like it's very much like a governance problem where it's like the decentralized nature of this infrastructure, the fact that there's no one single owner is how you actually get people to trust in using it as the backbone for all of these things, as opposed to appointing one single entity that would have tremendous power.
For sure.
The reason I'm driving at that point is I think there's a ton of use cases where you don't have that problem. Like you just don't, like you have like a very small community or even within a single organization. Like I'm not going to name any names, but I see all these press releases like, oh, this bank is using a blockchain to like move dollars, but only clients of that bank can use it. I'm like, what the hell is that? It doesn't really, why does the bank just...
So wait, let me tee it up this way, okay? And then let's go down this rabbit hole.
Yeah.
Because what I do think is going to be a really interesting conversation is like, what should not be tokenized? Because we're talking about what can. I think Ian just covered that pretty clearly. Dave, I know you have some opinions about what can't be, but first I want to like just kind of summarize what we said. So right now there's kind of two pools of where most of the activity is happening. One is on the really easy stuff, which you already said. Like let's use money market funds. You save about half of your fee by tokenizing. Okay, so really easy use case. Let's go. We already went through the technical reasons to do it. Then what Ian's talking about is now the things that are not the low-hanging fruit are the next frontier of which tokenization is tackling. This is private credit, private equity, others. Those
markets without
the infrastructure.
Markets without marketplaces.
Okay, so that's the next, I think, frontier.
Yeah.
Well, that seems to be coming. We'll see. That's early days for a lot of the startups in it, as Ian knows, because we're working on it. So now when you're in that world, that's the one that I think is really interesting to unpack today. So what out of the world now should not be tokenized that you guys are seeing people trying to tokenize?
That's a good question.
I mean, I don't love the idea of tokenizing collectibles, for instance.
Because you don't think the market's...
I think that the delivery... Collectibles are inherently a physical item. The delivery is difficult. don't think the transferability is made any easier through the tokenization.
Wait, just to be clear, so when you're saying collectibles, you can be talking about an art piece.
Pokemon.
Because we hear
Pokemon
about
card.
Pokemon cards,
The fractional,
of course we hear about the art
I don't
pieces
get
too.
the fractionalized Picasso piece.
Yeah.
Right? I don't get that. The coordination problem for the sale is difficult. Maybe it's an asset class, but we all can't hang it in our house. That's a market that transferability actually works pretty well. I've got the painting, you got the money, it's fine. It doesn't need to trade very often to do it. It's
the
not.
only
It's not.
reason
It's not.
You would do
it's,
that
it's
is
not
because people want access to the asset class, and right now they can't get.
I mean,
access
look,
to the
I'm
asset
a libertarian. People should be able to do whatever they want. But if you're asking me, like, do I want to spend my time on that idea? Not really. I mean, that's basically the question. I think people should be able to do whatever they want, but I don't like the idea. And so I also think that art doesn't have the jurisdictional problems that we spoke about before, right? You can go with the painting and sell it, and people move art around the world. So I think collectibles, memorabilia, art. There was a huge push in the fractionalization and tokenization of the art market. I've not seen it be very successful yet. I'm sure I'm going to get a bunch of hate mail on this about how awesome so-and-so's deal or project or app is.
Something I know about you. You're happy to be wrong.
Yeah, like
Listen, if
show
someone
me.
proves you wrong,
I would love to. So I don't think that makes a ton of sense. As an example, I don't know. Do you have some that you don't like? Internal bank ledgers that tokenize deposits for their own users?
Yeah, I think it's like any use case that isn't like a difficult multi-party coordination issue.
Yeah.
So like if there's like a bank or a multinational or an ecosystem and it's using a blockchain to just move information or assets amongst within its four walls, doesn't make any sense to me. Like blockchain is much slower, more expensive. Why not just like really what you're doing is just like, I think like 9 times out of 10, that's just like everyone's talking about tokenization. Like we're going to just like ride on this and get some press releases out. And we have some innovation budget and the CEO says we need to do something with tokenization, but we don't know really what. So let's do something and we'll tokenize our own customers' money and we can move these tokens back and forth. Like, that doesn't make any sense to me.
And there's also like, I think this is all on a scale. Like, what are the things that I like the most to tokenize and what do I find the least interesting to tokenize? Look, people are very excited about tokenizing funds right now, right? Obviously, we're involved in that at Republic. We think it increases distribution globally, and we think it increases access, and it has a bit of efficiency gains operationally. But I think what's really interesting is tokenizing the root instruments inside of those funds. I think there's a lot more composability there, and you can break those things up in a little bit. I think everybody.
Give us an example.
You could tokenize you could tokenize an SPV that has inside of the SPV an interest in a fund that's got credit instruments, or you could tokenize the underlying credit instruments. I think there's reasons why the big fund managers want to distribute tokenized versions of their funds. It increases distribution, and that's great. But I think that we'll get more interesting financial engineering. We'll get more interesting real-time securitization. We'll get more interesting in liquidity and tighter bid-offer spreads if we actually attack it at the root level. Frankly, I think the reason that we haven't yet is people haven't figured out how to crack that egg, and I think we have figured it out. But that to me is on the sliding scale of where do you want to be. You can always build up to the aggregated financial product. If you tokenize at the root instrument, I think you have a lot more Lego pieces to play with,
for sure.
And so I think it's all sliding scale. Like, do I like if there was a opportunity to easily leverage through crowdsourced wholesale funding a credit fund like what ACRED's tried to do and others, I think that's really compelling. I think there's real value in doing that. But I think one of the things that would even support that the most is, once again, tokenizing at the root instrument, getting those leverage loans going, and then making that happen.
I think a lot of the misguided tokenization plays have been followed this line of thinking, which is okay, I'm an institution. I'm looking at the crypto market. What the hell is going on over there? How can there be $3 trillion of market capitalization, hundreds of billions of dollars a day in liquidity, trading these fart coin and Trump coin, and I want all that money to trade mine, right? And so people are like, oh, they just look at the crypto market and they say like, look at all that trading, look at all those people, look at all that money. I'm gonna put my assets in there, and surely that pool of capital will much rather buy my private credit coin as opposed to fart coin. Like, it's way better. So I think they're looking at like crypto as a pool of captive capital, and I think like what we've learned is that like that's not actually the case.
Yeah, let's talk about meme coins for a minute.
Yeah.
Why do people buy meme coins? So it's rhetorical. Let me give you my answer and we can talk about it for a minute, because that is a token. Okay.
Yeah.
It's not really tokenizing anything but the following. It's turning the concept of Ponzi into a casino game.
Yeah.
And it's kind of an interesting casino game, right? What you're really, it's a shell game that everybody knows they're playing a shell game, and there is no intrinsic or underlying cash flows or value at all. And it's 100% a form of gambling.
Yeah.
There is zero investing in meme coins. It is 100% gambling for gambling's sake.
Yep.
It is tokenized, which means it instantaneously settles and rides these rails and is composable and easily tradable. But it's the opposite of an RWA. It's certainly not a real world asset. What I think people miss the point of in when they say, and I don't own any meme coins.
Not one.
Not one.
Never.
Not never, but I don't currently own any. So
I don't know which ones you
own. So why do people trade in them? They actually trade in them for different reasons than they buy a tokenized credit instrument. They trade in them for the kind of returns and dopamine hits
That's exactly my
that
point.
come with gambling.
Yeah.
So the idea that you're going to take the fart, to your point, that I'm going to take the fart coin investor and make them into my
private credit
tokenization is that's not the same customer.
Yeah.
But I can tokenize that private credit and bring in the trillions of dollars of traditional markets into better rails with tighter bid offer spreads, greater liquidity, greater transferability, and greater capital efficiency. Yeah. It's not about winning the market share from I don't want to say any actual meme coin, from Glasses coin. It's not about winning market share.
You can say the actual meme coin.
No, that's okay. From Glasses coin, I'm sure there's a Glasses coin. There's an everything coin at this point, but from Glasses coin, and you're not going to take that market share necessarily. What you are going to do is you're going to massively grow the traditional market's demand for tokenized versions of itself. So much so that I think when we talk about markets in 20 years, we're no longer going to be talking about tokenization.
I agree.
Tokenization is not even going to be a subject. It's just going to be
20 years seems like a long time, actually. I think that might be sooner.
5, 10, I don't know. Some amount of time into the medium term. Some amount of time where the businesses that are successful today will look like mature parts of financial infrastructure, like you can point to in the TradFi world right now, which is incidentally why TradFi firms are buying up blockchain companies and stablecoin companies and infrastructure plays in the Web3 space.
Well, and so we hit on two concepts I think are important. One is you have the degen crypto traders, which we all call the degen crypto traders, which for our listeners just means these are the people that are getting the dopamine hits by trading.
Yeah. Gambling.
Yeah. Oftentimes gambling. There's a little bit more sophistication sometimes if you're doing the altcoin strategies and other things. But okay, so you have that. A lot of them are also now very easily just going into prediction markets, right? Yeah. So that's why you're seeing the massive rise of prediction markets, because it's actually just allowing you to continue to do that. 1. 2, when you think about RWAs, Ian mentioned RWAs, which means real world assets, and that meme coins are the complete opposite of what we're talking about in RWAs. Just for everyone's kind of a few stats, like they tripled last year. So the volume of RWAs tripled last year. It's at 30 billion now. I said earlier, BCG thinks it's going to be at 19 trillion by 2033. So the things that are driving that are already what we talked about. Tokenizing all the low-hanging fruit, Dave already covered. Tokenizing the things that are not the low-hanging fruit, that are very complex, that Ian covered. But now I think the thing everyone's talking about is tokenizing equities. And we've hit on it a little bit, but I want to go a little bit deeper. So when New York Stock Exchange and when NASDAQ are saying they're putting real money into companies that are, let's call them just digital asset companies because they have a bit of a different strategy here. But why are they so interested in tokenizing equities? Is it simply because Dave is saying, hey, there's a big pool of capital that they're like, we should be able to access that pool of capital? Is it distribution? Is it because they want to be able to potentially be the marketplace for some of the private?
Look, at the end of the day, they understand that there's a big global market share to grow. 24/7, 365 is the way to get there. 24/7, 365 is made a lot better through instantaneous settlement because the rest of the institutions that are required for settlement aren't open at that time. Losers in that are the money center banks that get to tie up the float of settlement. Winners in that are the key customer of the who's the key customer of the exchange? It's high frequency trading firms. Right? That's the key customer of the exchange. And they're the most benefited through faster, shorter settlement times because less of their capital is tied up at money center banks. And so their balance sheets are more optimized. They're more efficient. They're more profitable. They're happy.
Maybe. I mean, blockchains are going to be much slower than what HFTs are used to right now. Much slower.
I mean, we can find ways to back.
So you have people like these HFTs like blowing up mountains, so they get like better line of sight, fiber line into like the data center.
I mean, we'll
in Philadelphia.
See. We'll see what blockchain New York Stock Exchange picks. I don't think they've picked one yet for their new tokenized stock trading. But long story short is they get.
Is there a blockchain? There's not a blockchain in existence that can actually move as quickly as the current industry standard, though.
No.
For high frequency trading.
No, but you can augment this to then batch settle on the chain the transactions at the end of the day. So that doesn't take T+2.
And that's why
I mean you can do there's a hybrid approach here, which is likely to be used.
I could be convinced. I'm not like ruling it out. I could be convinced that like this move of like the New York Stock Exchange to blockchain rails is like a good thing. But I'm not yet convinced because the Australian Stock Exchange in, I want to say 2018, maybe even earlier than that, announced that it would rebuild itself on blockchain rails. And it was working with a company called Digital Asset, whose CEO at the time was Blythe Masters, rock star from JP Morgan, really like smart, accomplished, and professional. And it was a big win for like all the sort of tokenization proponents, including myself. I want to say 2018, 2019. I mean, this is a while ago. Let's look it up. ASX blockchain project. It's now defunct. It got canceled. It was one of the most disastrous like technology projects like in the history of Australia. Like they spent, and there was, every acrimonious sort of blame game going on. Let's see. So it was abandoned in 2022, citing dysfunctional management, complexity, scalability.
So there was a business case why it didn't work, but there's also a technical case why it
so I guess what I'm saying is like in the framework that we've kind of talked about earlier, where tokenization is great in markets that have no infrastructure or in markets that have a real sort of multi-party coordination problem where there's not like one single governing body that we can trust to sort of run this ledger for everyone. Mm-hmm. Stock markets aren't that. Like the New York Stock Exchange is the market, right?
So
like
are they only doing it to grow their
I don't know.
share globally?
It's part of me says that they are doing what I just said, which is they look at what crypto's doing and they say, we want that. Like we want this like
that
viral
good crypto mojo.
Yeah, we want this like
good crypto mojo.
All the people making all the money.
We want this like viral, like greedy, just like explosive growth, and we want everyone in the world to like be trading stocks 24/7 because like that's great for our companies because they have more buyers, and that's great for us because we make more fees. But I'm not necessarily like sure like why they need a blockchain to do that. Like why does the New York Stock Exchange need a blockchain to go 24/7? Like I don't know like what the I don't know if that's like a technology. I think that what if they just said today, oh, we're 24/7. Databases don't turn off on the weekends, right? That could just be like a change to their rules. You know what I mean?
Cash rails, settlement. You want the instantaneous settlement. It's for the settlement. It's so you can settle more quickly. Right. That is the purpose. It's so you can settle more quickly. And how do you settle more quickly? We don't have a framework to do that outside of these public blockchains that allow for instantaneous settlement.
Yeah.
That's the key point.
World in, let's say, 5-10 years, who knows what the timeline is, where we think that how we can watch the stock market on a daily basis, on an hourly, minute basis, and what's happening from a trading perspective. We think that will be the case over the weekends, where there's as much volume moving on the weekends. Wall Street's going to have to change the way that they operate because they're going to have to put traders on weekends.
Okay. Let me give you an important example of this. The biggest risk in a margin loan for a margin lender in a stock is not what happens between 10 a.m. and 4 p.m. when the market's open. When the market's open, if the trader gets liquidated, they just liquidate it into the market. The reason the cost of capital is where it is and not lower is the gap risk between the close of the prior day and the opening of the market the next day. It's the lack of a contiguously open market that drives up the cost of capital in the lending space for securities. By having a continuously open market, you do away with the gap risk. You have a more normal distribution for slippage, for the liquidation of that underlying collateral. Thus, lenders can lend at a lower price. Borrowers can borrow at a lower interest rate. Obviously, every time that interest rates are lower, investment capital goes up. It's sort of a fundamental tenet of economics. So I think one of the real practical ways to think about this is having a market that never closes means that leverage is cheaper. Leverage is cheaper means more money flows into the market. Everybody seems to like when more money flows into the market.
I think, thinking this through, if the New York Stock Exchange said all stocks no longer have to trade on the stock exchange, that to me would be
that's a separate conversation.
But that would be a big improvement, because then it's like, okay,
so let me share with you what New York Stock Exchange is doing, and we can bring people from NICE up. I don't want to butcher this, but they're working on their ATS for their new tokenized stock trading. Right. So those aren't trading on their main bulletin board. Those are trading on the alternative trading system that they have, their own.
What's trading on the ATS right now?
The digital tokenized versions of the stocks. So that'll be where we start to see some of this experimentation. NICE had some big announcements in the past month or so on it. So we can subsequent episode, we can bring on somebody from NICE, but that's what they're doing. They're doing it not on the main board. They're doing it on their alternative trading system.
Because to me, like, the big unlock would be, okay, someone in Argentina can now buy shares of Nvidia as long as they have an internet connection. They can buy that. Like, that's a big unlock. That would be like a reason why tokenization is a good thing. It's like, and then they could, there's no gated community to get into that. Like, I don't have to onboard to JP Morgan or Robinhood to do that. I can just go onto a decentralized exchange.
Well, look, that's an interesting point. Look, there's a lot of businesses that have sprung up. Republic's involved in some of this. And okay, let's take a step back. This equity piece can be broken into public market securities and private market securities. Okay. In the public market securities game, there's a lot of players that are playing right now to service just that. And they're going to go head to head with the major exchanges, who are huge incumbents with massive resources and a heck of a business model, and wildly profitable today, and just go from strength to strength. I mean, look at ICE or et cetera, which owns ICE. Okay, so that's the public market space. As an investor, I think it's going to be hard to compete against those guys now that they've decided they wanted to get into the game.
But are they truly, before you go to the private markets, so it sounds like they are truly, from everyone I talk to, from everyone I'm sure y'all have talking to, that they truly are going into the game.
There.
But like, what does that actually look like? So is it true that if I'm in Argentina or I'm in Ukraine and I want to own Nvidia stock, I'm going to be able to log in to some platform in the next few years and own whatever portfolio of U.S. equities.
Or not even log in. Just connect your wallet.
Yeah,
they don't even know who you are.
Yeah, connect your wallet, which is a Web3 version of logging in.
Yes, some version of that. We'll see what shape it takes. Yes, that is real.
So that's like a transformative thing to me.
Yes,
like just running the New York Stock Exchange on a blockchain is not really exciting.
I agree,
to me.
but one gets you to the next. So that's the end state, is the one Samantha's talking about. Now the question is, who? Now there's the issue of KYC. Let's hold that aside for a moment. Who's going to win that game? Is it going to be these startups that are taking effectively U.S. equities, dropping them into Jersey trusts, using Swiss regulatory wrappers, and issuing claims on those trusts as representations of that Nvidia stock? That's clearly a business model. There are clearly companies doing it. I don't want to say any names. You know who you are. Super cool. Congrats on your acquisition. Love you guys. But you're going to compete. But when NICE gets into this and NASDAQ gets into this, like they understand the same framework. They're going to be pretty big players. There could be a good runway until you're going head to head with them in every market niche. But eventually, like those guys have a major advantage. And by the way, the people at those exchanges are really smart. I mean, they're not like slow-footed.
Oh, no,
they're sharp.
But this changes everything. This changes how investor relations has to work. It changes how
completely.
You think about how many buyers you now have. It changes
totally.
Well, I think for companies, it's a great thing. And that's like the ICO boom that we talked about. Like that was not, so the point is for companies that are raising capital, if you have this whole global market that can now buy your stock or your debt 24/7, 365 with just an internet connection, you've opened up the pool of capital that you have access to, either debt or equity. That's a great thing for the people listing on those markets. And the ICO boom was essentially like a small manifestation of that, which is and it was pure regulatory arbitrage, right? It's like no one needs an S1. They don't need SEC approval. Like we're just going to launch our token. Anyone can buy it. We're going to take the money. We're going to build our business. And I know you talk a lot about tokenization as like a tool for capital formation, and that we should get away with the accredited investor stuff because that allows everyone to sort of participate in these capital formation events and stuff like that. But will ICE or the New York Stock Exchange or NASDAQ, will they allow this sort of permissionless dynamic to exist?
Well, there's no accreditation in the public markets. Okay. So how permissionless we go vis-a-vis KYC, look, I think that the more they get, more product out there, the more surface area of distribution that will be, the easier it will ultimately be to take these tokenized assets, drop them into wrappers, and make permissionless non-KYC versions of them.
Right.
Representation, whether that's done
that
through
makes the most sense.
Whether that's done
for companies.
It's clearly a benefit for companies to have more buyers of your stuff. Obviously, you're out there selling stock, you want more people to be able to
but you also don't want North Korea to take down 30%.
You know, I think there's of course the risk of that. I don't think the North Koreans are going to be a major player in the U.S. stock market anytime soon. I just think law of numbers. But look, there are KYC.
That would be crazy.
There are KYC
hostile takeover.
There are KYC. There are KYC.
I mean, they're already messing with our DeFi markets.
Yeah.
You know?
There are KYC AML issues. Growing the surface area doesn't do away with them. Public markets are still going to have public market rules. The private market piece gets really interesting. So the private market piece does not have these massive incumbents who, once they decide to come in with all the network effects and all the connectivities and all the regulatory moats that they have, like that doesn't exist. Whether that's, Republic or other players of the private market space, Profit, et cetera, there aren't those incumbents in these private markets, and private markets are growing substantively. And with the advent of AI and the 5-employee billion-dollar company, private markets are just going to continue to be a big secular trend. And there's a lot more white space and a lot more opportunity for people to carve out the institutions of the future, because you've got you got secular growth, increasing global demand for U.S. privates, which is a tailwind, and you don't have those massive incumbents. There is no big incumbent organizing the trading in private markets. There is no functional trading in private markets, which is actually shocking when you take a step back and think about it. Really shocking.
Especially considering how big they are.
I think in that world where everyone with an internet connection can hold financial assets, stocks, bonds, whatever it is, loans, is as powerful as the stablecoin vision, which is true today. Yeah. Now stablecoins allow anyone in the world with an internet connection to send, spend, receive, save, and earn in dollars. It's why it's so powerful. There's, I would say, two huge problems that we have to reckon with for that to actually be the case, or just accept that they are. With, you know, the benefits comes some disadvantages. One is because these tokens are bearer instruments, if you lose them, they're gone. So will we accept a world where you could invest all your retirement savings into a diversified portfolio of U.S. equities that are represented as tokens, forget your password, and it's all gone?
No, we're not going to accept that.
Okay.
But
that's how it works today.
But that's a false choice.
Yeah.
So that's a false choice. Both Profiter and Republic are in their security token business. We use blockchains that have security token standards. Mm-hmm. If people lose their wallets, they do not lose their security tokens. We can burn and reissue those security tokens. So in the businesses that I'm involved with that are in the business of selling tokenized securities, be they registered or unregistered, equity or debt, we use security token standards where we can burn and reissue.
But you need to know who those people are,
yes.
Right? Okay. So how does this world where we talked about anyone with an internet connection work?
I'm not up to that world yet.
Okay.
I'm still with the world where everybody who can KYC gets to participate in these markets.
Okay, but then,
and these markets themselves have marketplaces. But the step you're going to probably means that if you can't KYC, but you can get a proxy version of it, then you lose the benefits of that security token standard.
Right.
And that's the trade-off that people make.
Right.
Now, it will be increasingly easy for people to KYC into these markets because every day there's another dollar that goes into the KYC tech stack, right?
Oh,
it's still an awful experience, but it will get better.
Right.
It is not going to stay this bad forever. And increasingly AI is going to make that easier to prove personhood till it doesn't. But it will, and there'll be more money that goes into that software.
Right. And
there's a big world out there of KYCable people who want to buy these instruments who have not been able to and will now have access to them.
So that sort of like chargeback problem is one that, like you said, I assume that there will be solutions for it, but it's still not exactly clear. There needs to be some sort of like market-wide standard for this.
So it's difficult to deal with where you don't KYC the security token standard piece is hard. What I do think is interesting is there's a market dynamic at play where non-KYC'd permissionless versions actually can stay in line with the underlying asset, which as long as enough persons have access to the redemption window to go back to get the traditional version, the secondary market will sort itself out with a really small discount or premium, depending on how you think about it, to that more mainstream version. Right. So the market will do a really good job of that. So I think that's less of an issue in the permissionless space. But
you don't have to be tokenized. You don't actually have to be a tokenized stock in order to get the wrappers, though. So that can already happen.
Yeah, it does. That's an example I gave you where people take stock, drop it into SPV-like frameworks in Jersey under Swiss law, can do tokenized versions of that and sell it.
Well, it's like we talked about last week. There's the DeFi market, and then there's everyone else.
I mean, Republic has...
And then the hybrid between the two.
The hybrid of the hybrid is what Republic's doing with mirror tokens internationally with BitGet, where we've got a version of an underlying private security, say SpaceX, and we pay a variable return payout when SpaceX goes public. Not securities advice, all the disclaimers, but there is a lot of innovation that's taking place right now at exactly the nexus of private and public markets.
The second issue that we have to reckon with is privacy. So blockchains are public ledgers. The way they work is that everyone can see everything.
Hugely important issue.
Yeah.
So I think that.
Well, let me just play that out for the audience, though. What that means is that the way that these public ledgers work is so as not to require like a central coordinating party to ensure ledger updates are made correctly. They give visibility to everyone on the ledger that A and B have what they say they have, and that when there's a transaction, everyone can see that A and B transacted so that they know it is essentially stopping the double spend problem. Like I'm A, I have 10, you're B, you have 0. A gives B 10, I have 0, you have 10. The whole world sees that ledger update so that the next time A goes to try to spend something, everyone knows I have 0. I can't spend the same 10 units, whether that's stocks or dollars or whatever. I can't double spend that, right? So everyone has the visibility. A has given his 10 to B, and B now has that 10.
Yeah, that doesn't mean they know who owns the wallet.
They don't.
But they can see
but
who
they're
who
pretty,
has it.
but like they're getting like these firms like Chainalysis and I'm forgetting the other ones, but Elliptic, they're getting pretty good at doing the forensic analysis that they can figure out who those people are. And you do enough trades with, okay, I don't know, so I'm going to trade with JP Morgan. I trade with JP Morgan. I now know JP Morgan's wallet address. I had to know its wallet address so that I could trade with it. Now I watch JP Morgan's wallet and see where all of that goes. I may not know. You see what I mean? So
but there are frameworks out that you can transact through platforms that are peer-to-peer like where you don't necessarily know JP Morgan's wallet. So I, as the centralizing entity, whereas the distributed entity there, decentralized entity, however you want to think about it, can know what each of those wallets are on either side, but the wallets don't know each other, in theory.
In that, I think it will be solved, but your point, I subscribe to it, which is that there actually is no one perfect blockchain for all use cases. And like, I mean, this has been going back to sort of the history lesson I gave at first. That period in 2017 to say 2020, where everyone was focused on consortiums, one of the main reasons they all built on private blockchains was because of the privacy issue. The blockchains available to them did not give them sufficient levels of privacy to be comfortable. They didn't want to expose their book and their trades to the whole world. That came at a cost of centralization, basically. Mm-hmm. And so basically what these consortiums became was what we were talking about earlier, where they just came one big database. That you had one single trusted party, like you just said, that sat in the middle and basically served as the middleman and said, I'm going to validate the transactions. I know who everyone is, but no one else knows who everyone is. And so but with those private blockchains, they run into that issue that we were talking about, which is they have a coordination issue and they don't have the trustlessness that the public permissionless blockchains have, which allow them to get those network effects and sort of bring all of these participants in. And so let me say this a different way. All of the efforts to build these sort of private permissioned networks have failed. Yeah. Like not a single one has worked. I've been a part of a few of them.
What you want is public permissioned, if that's such a thing. But and look, you have a bunch of corporate chains that are coming to the fore now as well. We'll see how they wind up playing. We've also seen that
not work.
Yeah. That's my point earlier, is like these use cases where it's just like one corporation using a blockchain to move stuff within its own four walls doesn't make sense. Like, why not just use a database?
Yeah, because you want other people to connect off of, you want last mile connectivity from other institutions that can provide those rails.
Yeah.
Yeah, if they can get people to onboard to theirs, which is why Stripe isn't claiming that it's actually their blockchain.
Right.
Exactly.
Okay, so do we have more or should we move to close?
Let's move to close.
Okay.
I want more Tex-Mex. I want more Houston Tex-Mex.
It's Cinco de Mayo.
It is Cinco de Mayo.
Cinco de Mayo. Yeah. Well, we had a martini at lunch, so maybe we'll go have a margarita.
Yeah, I didn't. So I'm ready.
Okay, let's move to the signal.
It's 4 o'clock somewhere.
Remember, the signal is our wrap up of the episode, the one thing that you're watching in just a few sentences.
So we just touched on something, which is I think about there is how we think about vaults. We have them. David OpenTrade has them. We have vaults that are very specific to our credit products, where we automate the waterfall of capital coming through to the lenders and onto the borrowers in those waterfalls, and are very specific, where we're really trying to use blockchain to show the trustlessness that could happen through running an automated leverage loan distribution of capital. And I think that that's a really big innovation we can have in the market that is blockchain native, but somewhat specific to the markets that we're focused on. And I know Dave's got really sophisticated vaults that he's built over at OpenTrade. So vaults are a second place where we just need to be there and make them available and make them, really robust and trustable. And blockchains, I think, help us do that. So those are two places that directly shake out to how we're positioning the business and what we're investing in as a function of these themes.
That's a good one. what am I watching? I think for me, the most interesting thing to watch is how all this tokenization go permissionless? I think if it does, like BlackRock, all these big institutions that are doing tokenization, actually a lot of them have gone permissionless. Like BUIDL tokens like can trade on Uniswap now.
Mm-hmm.
Yeah, as of a few weeks ago.
Yeah. Right.
So they're tiptoeing in.
And so like and I think Franklin Templeton invested in Athena. And so I think if all these institutions lean into public permissionless blockchains and issuing assets on them and just riding with the same model that stablecoins ride with, which is anyone with an internet connection can hold them and trade them, that will be really, really disruptive, both in good ways and bad. But that will be really powerful. Like, I think that will have the maximum impact in terms of like change in market structure and like bringing in new buyers for these assets and bringing in new distribution and allowing new business models to exist, and more of like a 0 to 1 type thing. Yeah. I think if they all just go like we're going to do everything permission, gated walled gardens, digital islands, but they're on blockchains, I guess someone could tell me that it's going to be more efficient, and like I'm sure it might be to an extent, but like, okay, it costs $1 now, it costs 90 cents. Like, did that really?
Is that as revolutionary?
Yeah. That's more of like an incremental improvement. And I think like there's place for both of those. Like, I don't think it's either or. I'm never like a black and white guy, but the more and more that I see of this stuff go permissionless from the start, the more excited and more interested I am, just because I think it's going to have a far more wide-reaching impact on existing market structures.
That's actually in line with what I'm watching.
Okay.
So early stage VC, I believe in the world in which now anyone with an internet connection is going to be able to hold a U.S. security. I don't know exactly what form that's going to take, as we already discussed today. But in that situation, everything has to change for how U.S. companies with public stocks think about their business operations, think about their distribution, think about how their IR processes work, think about how traders are thinking about all the information that they're gathering and what's happening on overnight books. And it's just, there's so much opportunity there. And if that is the way the world is going, and which I believe it is, then there's going to be a lot of really great startups building in that space. And that's going to be a big opportunity.
Awesome. And that's the signal.
Love it.
That's the signal. Margaritas. Happy
Cinco de Mayo, guys.
Cinco de Mayo, baby.
Let's do it.
And happy birthday to you guys.
Happy birthday to you.
Sam.
Happy birthday to you.
She turned 25.
Yeah, I'm a millennial.
Yeah.
Nice. Everyone
Nice.
tells me happy birthday.
Yeah.
Okay.
It's a wrap, guys. Congrats.
Good job.
Good job.
Done.